Hello, everyone. I'm Angelo Robles, host of the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today, we are covering can your family and family office wealth management plan pass the 360-degree stress test? It features two very special guests who are the leading authorities. Very, very excited to have them on, and they haven't been on in a long time. And that would be Kevin Ellman and Paul Miller of Wealth Preservation Solutions. Gentlemen, welcome back to the show.
Thank you for having us.
Thanks, Angelo. Good to see you.
Well, I've been really pounding investments a lot lately, and that's always a great subject to cover, and we really enjoy it. But if your gains are going to blow up in smoke and taxes, or they're not going to transfer to your heirs for a variety of reasons the way that you would want to, and this is something that you have control over, then kind of what good is it? You're kind of defeating part of your purpose. So it is important to cover issues of what your purpose is, the tax issues relative to your investment, the estate tax issues, and lots of issues relative to wealth transfer. So again, we're really excited to have Paul and Kevin back. They break down such complex subjects probably as cleanly on an advanced level as any two people that I know. So what we're going to do today, everyone, that's a little different, although I do this once in a while, it's going to be more of a presentation format because visualization is important in this kind of discussion. I might have some questions along the way, and most certainly at the end of the presentation. And the presentation is relatively modest in length. On that note, what I'm going to do is I'm going to kick it over to Kevin Ellman, who's going to give a brief overview, adding to what I said, and then kick it off to Paul, who will officially start the presentation. Kevin, welcome. I give the control to you. It's all yours.
Thank you very much. I'm going to ask Paul to put up our 360-degree slide so I can describe what we do. So we've been doing this for about 30 years. And one of the things we've learned over that period of time is that in order for a wealth management plan to be successful, it really has to take into account all the different elements of a wealth management plan. So some of these, you're very familiar with, but we want to make sure we address all the issues of wealth preservation. So this is typically the areas of wills and trusts and gifting strategies. We call this wealth transfer planning. We want to make sure that the assets that you've built up over a lifetime end up going to your heirs without a significant reduction for taxes. And we're going to talk a lot about that today. Obviously, investment management is a critical component. We want to make sure that the assets are managed as well as they possibly can and the money grows as well as it can be. Risk management is really more of a defensive strategy to make sure that you don't have losses due to unexpected problems or issues. And then most family offices have been built around a family business. So we're not going to be discussing that at length today, but this includes the areas of exit planning, succession planning, making sure that the business continues. And then many families who've been able to build up substantial wealth want to help others. So philanthropy is a key component. Won't be part of today's discussion, but perhaps a future one. And the last and most important area is we call advisor coordination. This is the biggest difference between a successful wealth management plan and one that doesn't quite achieve what it wants to. So very few families will ever have their lawyer, their accountant, their banker, their insurance people, their investment people, all in the same room at the same time reviewing the plan. And this is the key to a successful plan, making sure that all elements are fully coordinated. So we use the example of building a house. If you were going to build a house, you wouldn't just go out and hire a plumber and hire an electrician and say, have at it. You first would hire the architect to make sure that you have a sensible plan. Then you'd hire the general contractor who's going to coordinate all the different trades to make sure that the house ends up the way you want it. So this is our concept. We feel that 360-degree wealth management is the key to a successful family wealth plan. So Paul, perhaps you could take us to the next step.
So when Angelo asked us on today, it was in anticipation that after the COVID relief bill has been passed, next on the agenda will be the tax bill. And as a matter of fact, it was reported in some newspapers today that Biden is now considering what is going to be included in the next tax plan. So as you know, the focus and the target is going to be the wealthy. And one of the main components is they're going to be looking to increase estate taxes. And just to give you an example today, if you can see we have 3 estate sizes here. If you have a $50 million estate, and we pick New York, if you have a $50 million estate today and you and your spouse were to die, the tax would be $15 million between New York and the federal government. On a $100 million estate, it's 40 million. On a $250 million estate, it's 114 million. So it's very confiscatory. But the bad news is it's only going to get worse. And why do we say that? Well, 2 things. Right now, and I'm going to cover that in a moment, the lifetime exemption is at a level that's going to be reduced in half in 2026. But there's anticipation that if a new tax bill gets passed, they're probably going to roll that back sooner than later. And if you take that same $50 million estate and you grow it at a 5% compounded rate of return, the taxes under the way the tax bill is structured today grow from 15 million to 33 million. And you can see on a $250 million estate, the taxes go from 114 to almost 200. So we have a very high estate tax, and it's only going to get worse. And so what we're going to talk about today is really one strategy to take advantage of that in conjunction with taking advantage of what we're probably going to lose in the next tax bill. So to that point, give you some basics. Every person today can transfer $11.7 million lifetime gifts or at death to, we'll say, the children or grandchildren. So a couple, the first $23 million, they can pass basically tax-free. Except if actually in New York, if you're in a state with no estate tax, that's the number. If you're in a state with an estate tax, while $23 million would be tax-free at a federal level, if you were in New York, that $23 million would be taxed up to a maximum amount of 16%. So even with the federal limits being so high, it's a state-by-state analysis that you have to do depending on where you live. But right now, if there's no change in the tax law, come 2026, that exemption is going to be cut in half. It's going to go from $11.7 to $5 million, which it was beforehand, index for inflation, $10 million per couple. So why do we bring this up now and what's timely about it? Well, the tax code today says that if you make that gift today, so if you were to take advantage of that $23,400,000 and they were to change the tax law, you would be grandfathered. So we have a window. We were under the assumption that window would be in place until December 31st, 2025. But based on the anticipation of a new tax bill, we think that's probably going to be rolled back to the end of this year. So Kevin, you want to talk about, our thoughts on getting it over the tax fence?
Sure. So this is a simple way to think about tax reduction. So if you have all of your assets on the left side of the fence, where they're in your estate, as Paul mentioned, a $50 million estate could have a potential tax of about $24 million. However, there are techniques that we use to get your money, what we call over the tax fence, to the other side, where basically you're in a tax-free environment. So given a choice, would you rather have money on the taxable side, where you're going to have a $24 million estate, or would you rather have that tax disappear by getting your money over the tax fence into the tax-free zone? So Paul's going to talk about a couple of different techniques, which are tried and true. They're not simple, but they're tried and true techniques that work, where you can actually make the tax disappear legally.
So what we were talking about, so imagine you have a business or a building, a real estate portfolio worth $50 million. And the nice thing with businesses or real estate portfolios, they throw off income. So we're saying if you have an estate and you have that real estate portfolio of $50 million, the tax on that incremental $50 million, as Kevin pointed out, would be $24.8 million if you live in New York. If you live in a state with no estate tax, that's a $20 million tax. So the question is, how do you get a $50 million building over the tax fence when we just went through, you have a $23 million exemption? So it doesn't seem to correlate. So we're going to talk about a very simple strategy. And when we say simple, it's simple to implement. There's a lot of moving parts, and it has an incredible impact on the estate tax. So let's start with, if you have a real estate portfolio of $50 million, if we were going to transfer a non-controlling, non-marketable interest in that. Under the current tax law, we can take discounts for lack of marketability and lack of control. And the typical discount we see is in the 20 to 40% range. For this example, we use it a 30% discount. So basically, we take a $50 million asset after discounts transferred for $35 million. So going back again, we are limited to a $23.4 million exemption. How do we transfer it? So this strategy we're talking about is not even using any of the lifetime exemption, because let's take that building. If you have a $50 million real estate portfolio, you're probably making conservatively $4 to $6 million in income. So think about setting up a structure where you'll actually sell that building to that structure. Going back to what we were talking about, you'll set up a trust out of your estate for the benefit of your children and grandchildren. And instead of gifting it, we will sell that building into the trust and take back a note. And going back to it, so we'll sell a $50 million building after discounts for lack of marketability and lack of control. We'll be selling it for $35 million. And if you had an income, I'll just for a round number, say $5 million on that, you can transfer that in an 8 to 9 year period. So after an 8 or 9 year period, what's going to happen is you'll be receiving, instead of receiving the income as income, you'll be receiving it as buyout proceeds. And as we've discussed, all of a sudden that note's paid off and we have $50 million that went from this side of the tax fence to this side of the tax fence. We didn't make the asset disappear. We accomplished what we wanted to, getting it out of your estate into trust for your children and grandchildren. But what we've made disappear is the tax. And why is it important to look at it now, and why is it timely? Well, right before Donald Trump was elected, there was legislation in the Treasury Department that they were going to do away with valuation discounts. And when Trump was elected, they put that on hold. There's full anticipation that this will be something that will be looked at again. So again, instead of being able to sell it for a discount, while we can still take advantage of this technique, instead of selling it for 35 million, we'd probably be selling it for 50. So we have probably a limited window on how long we can take these discounts. And then the second part is we are in historically low interest rates. If we did a sale today and we took back a note over 4 to 9 years, the interest rate for an intra-family sale is 0.52%. It's almost interest free. So going back to that concept, if we were making $5 million a year in income, we could sell this in probably 7.5 to 8 years. And again, going back to what we discussed, we've magically made a $25 million tax disappear. And going back to the original slide, that's not even taken into appreciation. If that building appreciates in that 8 or 9 year period from 50 million to 70 million, we've made a $70 million disappear for tax purposes. Kevin, you have anything to add to that?
Well, I think it's interesting because it's very timely. We don't know how brief the window is, but we do know that the administration is actively working now to construct tax legislation, which would probably limit these opportunities. So if this is something that you might want to consider, making significant gifts, and there's another point that usually people say, well, that's great. I mean, I gave away the asset, but I want the asset. So there are other techniques we can use where you can give away the asset, but keep a string on it just in case you might need it. Because take a look at this slide here. When you say to somebody, well, why didn't you just give away $25 million? Most people say, whoa, slow down. I'm not sure I can afford it. And maybe if I could afford it, I'm not sure I want to lose control of my business. And what if for any reason whatsoever, I need the money back? So, those are some of the questions you have to answer to get over the hurdle of, getting comfortable with the idea that you want to let go of some assets. So we have some techniques where you can get the asset over the tax fence, make the tax disappear, and still, if you may need it as a secondary measure, have a string on that asset that you could get to it if you need it. And that usually addresses these three concerns. I don't want to lose control. Maybe I can't afford it. And what if I need it back? So it's important to know that you can address those issues.
Yeah, as Kevin says, usually when we start working with the client, we have a pretty good idea of what can be accomplished, what can. But if we were to take the lead, is we're going to make your estate tax disappear. And the way we're going to do that is we're going to transfer all your assets over the tax fence into trust for your children and grandchildren. The normal reaction would be, hey, thanks, it was nice seeing you. We'll call you sometime. So we've designed it in such a way that at the end of the day, if it's done properly and your concerns are that you don't want to lose control of it, you may need access to it someday, we can set up certain specialized trusts that the spouse will have access to, which will thus, while you get it over the tax fence, you'll still have access to the income if required. So that should not be something that stops you from exploring this technique. Kevin, you want to talk about the book we just wrote?
So let me just hold up a copy. Paul and I just completed our third book. Can your family wealth management plan pass the 360-degree stress test? Hot off the presses just this week. So if you'd like a copy of the book, please communicate with us via either Angelo or Elizabeth. You can see her number there, and we'll be happy to send you a copy of the book. You can also go to our website where you can actually take the stress test. So I think there are about 20 questions, and you answer them yes or no, and it'll give you a score. And then you can decide, well, I have a pretty good score, my plan's in pretty good shape. Or maybe it shows you that, there are some areas of weakness that maybe you should address. And then you can decide if you want to reach out to us, and we'll contact you and set up a call. So you can get a copy of the book. You can set up a consultation with me or Paul, and you can also go online and take the stress tests. And please, we'd love for you to get the book. We're very proud of it. We did a lot of work on it. We're very pleased with it. So we'd love to send you a copy.
And before I turn it back over to Angela for some questions, the big point we want to make is the tax is significant today and it's growing. And with the proper planning, we've done this, I can't even count how many times we've done it, but we've taken businesses that are now worth hundreds of millions of dollars and have been able to successfully transfer to the next generation, bypassing 100% of these state taxes. And as Kevin said, there's nothing, we're not cutting edge. These are tried and true techniques that have been tested out over time, and it's able to be accomplished with a well thought out plan strategy. But again, going back to that slide, you need to overcome your concerns. What happens if I need it? Can I afford it? And the whole process that we built, the 360-degree wealth management process, is to ensure that before you transfer any assets, you understand the impact it will have on you, both from a financial ability to maintain your lifestyle, as well as to minimize the estate tax. And everything we work on is to achieve that balance. Angelo, any questions?
Yes, and perfect. I was going to say it'll be a little more interactive this way. So that was fantastic. I wanted to keep it kind of concise and to the point. I think, again, for the reasons that I noted, you could be a great investor, and being institutional on your investment approach for a wealthy family is incredibly important. Of course, along with managing risk, that's a foundation. But if it goes up in smoke in taxes and estate taxes and wealth transfer, then you really haven't maximized. So I think this is really, really important. We're going to get to some of the questions, including with the audience, but that you brought up to me in my perspective on the wealth transfer part. But before I do that, if you don't mind, if I could transfer to something that's applicable for me, and that would be, now that there is the blue wave, and I know that's months old, what impact is this having this year and moving forward in the future that we're 100% familiar with on income taxes? If you could give a bit of an overview on that, I would like to understand that better.
Sure. So actually, I like to use the word blue ripple. So I think that obviously there's a Democratic president, Democratic House, but the Senate is, barely under control of the Democrats. And as a result, I think it's going to be difficult to pass the most onerous tax increases. I think there certainly will be some tax increases, but I don't think it is going to be as bad as it would have been had there been a true blue wave. So I think we'll see some, but not as bad as we originally anticipated.
Well, then let's talk a little bit, since you used the state of New York, so New York City, I'll make it even worse as an example. For someone who is a high income earner, what's the highest federal rate coupled with New York, the city, and I guess what people loosely define as the Obama tax? I mean, aren't they looking at over 50%?
It is.
Well,
Go ahead, Paul.
Yeah, there's actually an article today in the New York Post where they talked about both the New York Senate and House have similar bills where they're looking to raise the highest income tax rate in the city. If you're a city resident to 11, on the state level to 11.85, when you add in the city, it's 15. So you add that 15 to what today is a 37% tax, which will probably go back to 39.6.
Right.
So then you're looking, and since it's no longer deductible,
Well, you're not making me feel good today, Paul.
well, that's what previous before you always say I'm only paying 60% of the tax because 40% it was deductible against the federal. It's no longer deductible with the $10,000 SALT limit. So if they pass that bill in New York, which is no guarantee because they did get some significant relief in this COVID bill, but the one person who was holding the fort against that is Cuomo, and as you know, he's under some pressures now. It'll be interesting to see if he's able to hold the line. But both the House and the Senate have the same bill that will raise it at a certain level to up to 11.85. As I said, add in the city, add in the federal, and you're up over 50%.
Yeah, and that would apply to many people of making high earning in California. And it's not like Hawaii, Minnesota, Massachusetts are so great, and Illinois, they're pretty bad too. Like, wow. And this is probably one of the reasons that we're seeing somewhat of an exodus to Florida for those of us on the East Coast, Texas for many people. And I could also throw in for some, I know in the venture capital community in Wyoming and Nevada, et cetera. This is probably going to cause a flood of people, and I could say talented people, maybe entrepreneurs and high income earners, to other states, driving them away from the states that I noted, California and New York, which the irony is they're taxing more because they want more revenue, yet they're chasing the people that have that revenue away. There's a little bit of a weird dynamic there.
Well, the last time they did this in New York, there was a mass exodus last time they raised it. And there's that concern it's going to happen. And actually, we're a perfect example. We have, our two main offices are in Bergen County, New Jersey, and Sarasota County, Florida, which I happen to run the Sarasota County, Florida office. And much of that was driven by the fact that, one, many of our clients have been coming down to Florida. And so, we followed them down here.
Yeah, no, for sure. That sounds like that was a great client. Paul, it looks like you might have won that one, at least for weather and state taxes.
Kevin and I flipped, and I won that flip.
So when I'm really looking at it, it's possible for, again, high income earners who are ultra high net worth, especially in some of the states or communities that I'm noting, in theory, where half their income could blow up in smoke with taxes. And then if that doesn't add enough to the burden, they die in one of those states, especially that has its own state estate tax. And outside of the exemption, that likely is going to be coming down, another, depending on the size of their estate, another 50% blows up that way. It's like, wow, I think people kind of realize this, but like in Ostrich, they put their head in the sand, we'll deal with it next year. And with some of the strategies, with the low interest rates, with potentially life insurance being a part of it, maybe the best time to address this is right now.
It is. The concept to think about is that with the income taxes, there's a little bit less flexibility to really reduce those taxes dramatically. But with the estate tax, Paul and I often say a lot of this tax effect is optional. So using the strategies that we're talking about, plus the other tried and true, solid strategies, it's really possible to almost eliminate the impact of estate taxes. Now, you say estate taxes, but what does that mean? We're talking about when we ultimately pass away, and how does this affect future generations? So I think that's one of the reasons why so many people avoid it, because it's not today's problem, except that it is becoming today's problem because a lot of the opportunities to solve the problem are about to go away. So we really encourage people to think about this now while the window is open.
And the younger you start, the more effective you can be. We talked about the family. They have about 12 auto dealerships and worth over $200 million. We started this process about 12 years ago. They're still both healthy, living in Florida, doing well. But meanwhile, we were able to take advantage of the age and health status to make that transfer. So the earlier you start and the younger you start, and more importantly, there's techniques today that we probably won't have this time next year to take advantage of. So that's
For
why we
sure.
think the timing is perfect.
Mm.
I mean, basically, a lot of those, like you discussed, revolve around uh, taking what you currently own and putting some of it, I'm assuming, in a limited partnership or structure where, again, its marketability is limited. Henceforth, they're able to get specific discounts. And the keyword, many of these strategies are still around currently, and the interest rates relative to them are so low. I mean, it's hard to imagine they'll ever be this low again. Just the opportunity is ripe now to, stop the inertia and to take action. Part of what makes successful families successful generationally, again, it's more that actually investments are probably not even the top two or three. Building businesses and entrepreneurship, proper wealth transfer, and mitigating taxes, which relates to both income and some of the things we're talking about here. Yes, and non investing or taxation, family governance, leadership, absolutely. Those are probably all four of those would, in theory, even be ahead of investing. That could be debatable depending on how good of an investor and how much compounding over time. I get it. Okay, we'll call that number five. So those are probably the big five. And like you said, there are some things you have limited control over, but there are some things relative to taxation and wealth transfer specifically that you absolutely have control over. So I suppose from a question perspective, what I see with $100 million plus families, and we bring this up at our events, or I ask them, or you interact with them. Oh yeah, we did an estate and wealth transfer plan. How old is it? And I don't know, in today's world, by the way, if it's more than a year old, it probably is dated. But I often hear 3 years, 7 years, 10 years, 12 years. You got to update. And something like we're going through now, especially with some property values down, and that could be advantageous on real estate as well. You have to jump on this immediately, even if you did a complete estate plan pre-COVID 13 months ago. It's outdated now. So how do you get people to go from inertia, or I did it years ago, to actually taking action? This is a psychological one. It's not easy.
It's a challenge. The tool that we use is what we call the stress test, because until somebody sort of sees it with their own eyes, it's very hard to take action. So what we've learned over the years is that most people are working with very, very serious and competent advisors. And the issue is not so much that they haven't done any planning, but more issues of coordination. So we have found that sometimes the different advisors have not talked to each other. The different techniques they're using are not coordinated. And as a result, wealth slips through the cracks. So we think that the best technique is to take 5 minutes, take the stress test, and then you'll have a pretty good idea. Well, I'm in pretty good shape. I don't need to do anything right now. Or I noticed 2 or 3 things which I'd like to address. And then it's up to you. You can address them with your existing team of advisors. You can ask us what we think about it. But we think the best place to start is with a stress test. And then you'll get a pretty good idea in black and white. Is there an issue that should be addressed?
And to that point, if you decide there is an issue to be addressed, what Kevin and I do with the families is we do an initial stress test, meaning we'll then get all of the data. And most people, if you ask them how their estate plan works, and they tell you how it works, and you do the actual analysis, there's a major difference. They've done it again, as Kevin said, over a number of years. And many times, some of the strategies they've implemented are not coordinated with the previous ones. So what will come out of the actual stress test analysis that we'll do as a firm for the family office members, is you'll see in black and white exactly what's working in the plan, what's not working, and what's potentially catastrophic. And then, as Kevin said, you have 2 choices. If you're working with competent advisors and you feel comfortable with them, you can take that plan back to them and say, hey, listen, here are the issues, we need to address them. If you're comfortable with how we've done the analysis and you would like us to be involved, we'd be more than happy to become involved as well. So the stress test gives you an opportunity to take a step back, get an objective analysis of your situation, then make a decision whether you want to continue to work with your current advisors to fix it or have us involved to help.
I mean, besides the inertia that I noted, and I did it, but it was years ago, probably. And when you dig a little deeper into some concerns, you did hint at it earlier. It's the perception that in many of the strategies, in some, the answer is yes, but not many, that in many of the strategies, you completely lose control and access. One, there are strategies to address that. There are things you could do. But why don't you address that issue even a little more than you did during the presentation?
So typically the vehicle that we use to make the transfers into a trust that has multi-generational tax advantages. So once we transfer that asset, it'll be out of your estate for tax purposes. It'll be received by your children in trust. They'll have access to the assets, but they'll have full asset protection around those assets in case they get sued, in case they get divorced, and more. And just as importantly, when they pass those assets on to the eventual grandchildren, they'll be passed on tax-free. So you can pass on generationally at a tax-free standpoint. But the question comes back, but what about me? What happens if I give it away and I need it? So we use a specialized trust called the Spousal Lifetime Access Trust, that when we transfer the assets, your spouse will be a beneficiary of those assets. And if you need access to those assets, your spouse will have that access.
Excellent.
So,
Just to tag on to that, so typically we end up having two spousal lifetime access trusts. So the husband can get access to the trust in the wife's name, and the wife can get access to the trust in the husband's name. So they have to be done, has to be set up in the correct manner. There's a specialized way to do it, but it's not onerous. And that means that through your spouse, one or the other can have access to basically half of the assets. So that seems to, in every case that we've worked with, it addresses that issue. What if we need the money?
and that also goes back to the technique we use, that when we talk about transferring let's use the real estate portfolio, and they're receiving a $5 million worth of income. The building itself is static and it's appreciating. They're living off of the income. So by the way we've structured it, they're still going to receive the income over the next 8 to 10 year period, but it's going to be received as buyout proceeds. So they still receive that same $5 million. The difference is at the end of the 8 to 10 year period, instead of having an asset in their estate now that is appreciated from 50 to say $80 million with a $40 million tax on it, that $80 million asset is now outside the estate and not subject to estate taxes. But during that whole time, they retained the income. And now once it's out of their estate, if it's in one of those specialized trusts where the spouse has access to it, if need be, they still need access to the income, they have that.
For sure. No, that's very valuable to know. And I'm glad I had a chance to bring it up to hopefully alleviate some of the fears that people have relative to that. And there's other strategies as well that allow a level of access, et cetera. But again, that would be a really deep discussion, starting with Paul and Kevin. Would be great. And I would recommend it. And the stress test is great, by the way. I did it. It literally only takes a couple of minutes. It's very, very insightful. And it doesn't matter if you have a wonderful team, and I'm sure you do, of accountants, estate planning professionals, whatever, T&E attorneys, and even a family office. Again, these are the things that slip through the cracks. So much has changed literally in the last 12 months. And this year, a lot more will change. But don't wait until you think something's final. It's never final. Things are always changing. This is something you need to be proactive in. I probably used to say once every 3 years. I think I'm changing to actually every year. There needs to be a best practices checklist, something like that stress test that Paul and Kevin recommend, and I recommend you do it as well. I am going to go to our live audience for questions. By the way, now would be a good time through either, the Q&A or the chat feature. Looks like a couple have came in. I'm going to start with one from Lisa. Thanks for the info, gentlemen. Can you apply your strategy to private residences?
So private residences so the strategy we're discussing here is really for income producing properties. There are other strategies to transfer private residence. There's something called the Qualified Personal Residence Trust, where you basically will give the house away in a 10, 12, 15, 20-year time frame, continue to live in that house, and that asset then will transfer the trust you set up for your children or your children at a significantly discounted level. But the strategy we talked about really is for an income producing real estate portfolio or closely held business. But personal residents do have strategies that are very applicable and for wealth transfer.
That's for sure. It's just different than the one that you're talking about. And all the advantages that I spoke about to what you're talking about, which is effectively discounting, incredibly low interest rates. You mentioned it, but also this is a really, really important part, effectively kind of freezing the value of that asset. So the appreciation is the part that's mainly quote unquote accruing, incredibly tax beneficial. And you look at the historical returns of certain assets, they go up a lot. And imagine that compounded year after year, decade after decade. To have that out of the estate, that's a tremendous, tremendous value. Probably not necessarily the right time, but Lisa's question did remind me. And this is where it gets complex and where Paul and Kevin are great working with your current people who are probably really good. There maybe needs to be a little bit of a quarterback, someone to help kind of coordinate the efforts of the accountant, the attorney, and again, even if you have an MFO or a single family office professional, that whole concept of putting this all together, that's where it kind of gets a little bit complicated. And you really want to have someone to help coordinate that while still involving the likely tremendously talented professionals that you do have. There are some other questions. Let's see. What if you're single, i.e. divorced or widowed? Is there anything other than the SLAT?
To keep control. And so, yeah, that becomes, becomes a little harder. And again, it depends on the asset and how we structure it. And so there's certain ways to structure LLCs where you're going to be transferring the non-voting stock, the non-voting or non-managing interest or non-voting stock in an S corporation, and you still maintain control and management control and be paid as an employee or the manager. So so it's still an effective technique. It just has to be structured a little differently.
For sure, for sure. And yes, I'm sure people are wondering like, wow, this really, really gets complex. Well, what do you expect from the US tax code? It's probably hundreds of thousands of pages long, gets added to all the time. Of course, it's complex. And that's why you need help with professionals that can help to simplify it and lay out various strategies. Nothing is, I guess you could effectively have no estate tax bill. You could give all your money to charity. And for some families, that may be an applicable strategy to follow, or through a private family foundation, et cetera. But with most uber wealthy families, that may be a part of what they do. And that's very important, but they probably just don't want to give it all away. So yeah, there is a strategy that's kind of perfect from that perspective, but probably not what many of you want for your heirs, and some level of greater control of the resources that you worked so diligently and hard and took that risk often as an entrepreneur, and then were able to grow and scale it that very few people could. I understand from that perspective the opportunity of kind of keeping it quote unquote in the family, while still benefiting society, which many of you have done in multiple different ways, building great companies, employing people, supporting communities, and through philanthropy, things that I don't think are discussed enough. Now, of course, someone from the media is going to hear this and say, Angelo, there he goes again, he's a mouthpiece for the super rich. There's incredible people that are super rich and some that aren't so great, just like in any walk of society. But to not understand that they're not contributing in taxation and through their companies they built and who they employ and the value they give back to society is just foolish and looking at things very, very one-sided. I would recommend, as we kind of come to a conclusion, one, going to the wealthpreservationsolutions.com a website and doing that stress test. And if you would like a signed copy of the book, which I highly recommend, Can Your Family Wealth Management Plan Pass the 360-Degree Stress Test? I'm going to give, or the gentleman will give, including for my live participants in the chat feature now with Elizabeth, Kevin, and Paul, I recommend leaving your full contact info, mainly email and phone number, but many more people will watch this or listen to it, and the opportunity to repeat how they could reach out perhaps to Elizabeth Diallo, Director of Family Offices at your organization. That would be wonderful to kind of put a little bit of a bow on it and to mention verbally your contact info. That would be great.
Kevin, you want me to bring it up so you can read
If
it?
you put that slide up, that would be great.
And we're pulling it up now, everyone. So there it is. For those of you that are live or watching it visually, again, I recommend going to wealthpreservationsolutions.com. I recommend learning more, taking the stress test, requesting your free autographed copy of the book, which is great. And again, Elizabeth Diallo, a Director of Family Offices at the organization. That is EDALEO at W, P as in Peter, S as in Sam, LLC.net. And a direct phone number is 845-596-9740. Not just if you need guidance where to find the stress test or get your free copy of the book, both things that I recommend. But given my relationship with Kevin and Paul, who are incredibly busy, the opportunity for you as a listener, viewer, or member of Family Office Association to let Elizabeth know that you would like to connect with Kevin and Paul and maybe schedule that one-on-one. I mean, basically, you're getting two of the top guys in the industry to spend half an hour to an hour with you, kind of reviewing after you do the stress tests and perhaps reading the book. What questions you have in your situation, I would highly recommend it. Gentlemen, is there a conclusion you would like to give or anything that I left out?
Kevin, yeah, one thing we were talking about before that, the family offices are great in managing money and managing the return. And as we know, the markets fluctuate, as we've seen just in the last few weeks, you could have a 5% run either way. But what's really interesting, if you don't do the proper planning, that at the second, if you're married at the second death, if you're single at your death, you are that day locking in, depending on where you live, a 40 to 50% loss. It's a permanent lock-in. So that's the whole key to implementing these strategies, is because you want to ensure that everything you've worked for, when you finally pass it on, is that you're not locking in a 40% reduction. And that's what the tax is today.
I don't know if I ever heard it quite put that way, but wow, that really hit me really hard. Like you're locking in a 40% reduction in your estate, which is very, very true, mainly because that's the case. It's mainly because of inertia. I mean, this is just something you have to make the concerted effort to do. Well, on that note, gentlemen, Paul and Kevin, it's been tremendous. Thank you so much. I'm glad we had a chance to have a discussion today, to do some audience Q&A. To recommend your book, The Stress Test, on the website, and the opportunity of reaching out to both of you through Elizabeth very, very simply and cleanly. So it's been a pleasure to have you all on. Everyone, I'm Angelo Robles, host of the Angelo Robles podcast and the founder and CEO at Family Office Association, a global membership organization dedicated to investors, families of success, and their family offices. Check out our website at familyofficeassociation.com to learn more. And I also recommend our social media platforms, mainly YouTube. Go and subscribe. It's fast growing. We have lots of great interviews. And simply, it's Family Office. Go to YouTube, put Family Office together. You'll find it. You'll see my picture, a little dated, but I got to update that picture on there, but you'll find it nonetheless. Kevin and Paul, thank you so much. Look forward to the next time. Thank you.
Thank you, Angelo.
Thanks, Angelo. See you soon.